Have you ever dreamed of earning $2,000 every single month in pure passive income? Today, we are diving deep into the world of monthly dividend-paying REITs to show you exactly how to build that steady paycheck. Before we reveal the top 3 picks, let's understand the basics. A real estate investment trust, or a REIT, is a company that owns, operates, or finances income-producing real estate across various sectors. The pros are clear: high dividend yields, liquidity similar to stocks, and instant diversification into massive commercial portfolios that would otherwise be impossible for individual investors to own. However, there are cons. REITs are sensitive to rising interest rates, and their dividends are typically taxed as ordinary income, which is something every investor needs to plan for in their strategy. Our first powerhouse is Realty Income, famously known as the monthly dividend company. They are the gold standard in the net lease space, boasting an incredible track record of over 600 consecutive monthly payouts. Realty Income owns over 15,000 properties globally. Their tenants are the bedrock of the economy, including names like 7-Eleven, Walgreens, and Dollar General, providing extreme cash flow stability. With a current dividend yield of about 5.3% and a fortress-like A- credit rating, Realty Income offers a level of safety that is almost unmatched in the REIT sector. The downside? Realty Income is a victim of its own success. Because it is so large, it needs to make massive acquisitions just to move the needle on growth, meaning it might grow slower than smaller peers. Next, we have Agree Realty. Think of ADC as the high-quality growth play. They focus on omni-channel retail, meaning their properties are essential for both physical and online shopping experiences. What sets Agree apart is their tenant quality. About 68% of their rent comes from investment-grade tenants like Walmart, Home Depot, and Costco, which are highly resilient to economic downturns. While their yield is lower at 4.2%, they have a secret weapon: ground leases. This is the safest tier of real estate because they own the land underneath the buildings, not just the structures. The primary cons for Agree Realty are the lower starting yield and a heavy concentration in the retail sector, which could be a risk if consumer habits shift dramatically again. Our third pick is for those seeking higher yield: EPR Properties. EPR is a specialty REIT focusing on experiential real estate, the places where we go for fun and entertainment. Their portfolio includes movie theaters, Topgolf facilities, ski resorts, and even private schools. It is a unique niche that offers high barriers to entry and specialized underwriting knowledge. EPR offers the highest yield of this group at 6.4%. Plus, many of their leases include CPI-linked rent escalators, which provides a natural hedge against inflation. However, EPR carries more risk. A large chunk of their revenue comes from movie theaters, which face long-term challenges. They also suspended their dividend in 2020, which is a red flag for some income investors. So, how do we combine these for a $2,000 monthly paycheck? By diversifying across all three, we balance Realty Income scale, Agree's quality, and EPR's high yield. To reach $2,000 a month, you need $24,000 in annual dividends. With a combined average yield of 5.3%, that means a total portfolio value of roughly $450,000. Let's look at the share counts needed. To get this income solely from one stock, the investment varies based on the yield. We'll break down the requirements for each if you went all in. For Realty Income, at its 5.3% yield, you would need to own approximately 7,400 shares. This would require an investment of about $452,000. Agree Realty has a lower yield, so it requires more capital. You'd need about 7,500 shares, which at current prices would be an investment of roughly $571,000. Because EPR has a higher yield, it is the most capital efficient. You would only need about 6,450 shares, totaling an investment of $375,000. Remember, you don't need to have all this capital today. By reinvesting your dividends through a DRIP program, you can use the power of compounding to build toward that $2,000 monthly goal over time. Always keep an eye on market conditions. REITs are highly correlated with interest rates, so monitoring the Federal Reserve's actions is crucial for any serious income investor. Building a monthly income stream takes patience and the right assets. Start your journey today, and for more dividend investing strategies, make sure to like this video and subscribe to the channel.